Hello! In this section, we will be covering national accounts using the output approach. The national income and output is compiled every year in Sri Lanka according to a system of national accounts. So, Sri Lanka follows the SNA 2008. It's a statistical framework that provides a comprehensive way of preparing the national accounts. So we measure the national income of a country by calculating the gross domestic product or GDP. The higher the country's GDP or national income, the better off the country is. So GDP or gross domestic product is the value of all final goods and services produced in a given year. There are three methods of calculating GDP: the product method or the output method, the income method, and the expenditure method. Calculating the gross domestic product using the product method is to add up the final value of goods and services produced in the country, industry by industry, for a given year. When calculating GDP using the product approach, we have to be careful of multiple counting. That is, we should be careful that the product's value is not added several times. To avoid the multiple counting error, we use two approaches: the final value method and the value added method. Using the value added method or the final value method should give us the same result for GDP. However, a drawback of the final value method is there is sometimes a difficulty in identifying whether the good is an intermediate good or a final good. For example, sugar can be used as a final good or an intermediate good for a confectionery producer. Final good means the good is used for final consumption. Therefore, the most suitable method used to measure GDP according to the product approach would be the value added method. Value added is the difference between the final value of the product and the cost of the intermediate inputs. This final value of the product is known as gross value of output or GVO. So calculating the value added according to SNA 2008 would be gross value added is equal to the gross value of output minus cost of intermediate inputs. Gross value added can be estimated in two ways: using product source or the income source. Calculating GDP using the product approach will be continued in the next video. Bye.